In December 2025, a Chinese chip company rang the opening bell on one of Shanghai's technology exchanges, and what it brought to market was not a sensor, not a drone controller, not a telecom component. It was a graphics processing unit, a full one, carrying both artificial intelligence inference pipelines and three-dimensional graphics rendering on a single piece of silicon. Moore Threads calls this chip China's only full-function graphics processing unit, and it uses that phrase as a competitive declaration. Nvidia's position, stated and implied across its investor communications and software ecosystem, is that full function and competitive belong in different sentences entirely. Both claims cannot be right at the same time. The contest here is not abstract. Moore Threads has a die. That die has an architecture. That architecture is either a genuine parallel to how Nvidia built its moat, or it is the shape of ambition without the substance of performance. 2 rounds go to the bullish side on the scoreboard. 1 goes to the skeptics. The problem for Moore Threads is that the round the skeptics won is the one the title actually asks about. 3 rounds score the claim. The architecture, the momentum, and the phrase rivals Nvidia itself, placed under cross-examination where it has to hold. Nvidia's competitive position was not built on having the fastest chip at any given moment. It was built on building the same chip to everything a high-value customer might need. Train a model, render a simulation, run an inference queue, push a frame buffer. The generality is the moat. When every Chinese chip startup that came before Moore Threads looked at that architecture and then looked at what export controls had done to their node access and software options, most of them made a rational decision. Strip the graphics pipeline out entirely, focus all available die area on matrix multiplication, and sell an accelerator that does one thing very well. Cambricon took that path. Several others followed. The accelerator approach makes sense as a resource allocation decision. It also makes the resulting chip structurally unlike Nvidia in the dimension that produces the deepest lock-in. Moore Threads made the opposite call. It kept both pipelines on the die. The company describes its product architecture as supporting graphics rendering and artificial intelligence inference from a unified design, and nothing in the public record contradicts that claim at the level of what blocks exist on the chip. The bullish argument is that this is the harder engineering path, that it requires more design investment to do reasonably well at both tasks instead of excellently at one, and that the companies which took the easier path will be perpetually unable to contest the full range of workloads Nvidia occupies. On those terms, the architecture claim is real. Moore Threads is building in Nvidia's tradition rather than carving a narrower niche beside it. The skeptical response to round 1 is that full function is a product description, not a benchmark result. A die that carries both a graphics pipeline and an artificial intelligence compute block can still deliver underwhelming performance on both if the die area had to be split between 2 demanding masters. Generality is only a moat if the general thing is actually good enough at each function to win customers on that function. The question the architecture round has to answer is whether the blocks exist on the die, and on that question, the answer is yes. The question it cannot answer yet is whether those blocks perform well enough to matter in head-to-head use, because no independent third-party benchmark comparing Moore Threads' current generation against Nvidia's current data center lineup has been publicly confirmed as of the information available here. That absence does not disprove the architecture. It limits what the architecture claim can be awarded. Round 1 goes to the bullish side, but narrowly. Choosing the Nvidia-shaped path and executing it to Nvidia-level outcomes are still 2 separate accomplishments, and only the first one can be confirmed right now. The die is genuinely unusual among Chinese-designed chips. The performance inference does not automatically follow. A company that wants to challenge an incumbent needs to survive long enough to iterate. Iteration requires capital. Capital requires revenue. And revenue at scale requires either a public market event or sustained institutional backing at a level that is difficult to maintain indefinitely without a path to liquidity. Moore Threads got the public market event in December 2025 when it listed on China's STAR Market, which is the exchange designed precisely for technology companies at the growth stage, before sustained profitability. In the quarter following that listing, the company reported revenue growth of approximately 155% year-on-year. That figure comes from company-reported data and has not been independently audited for the purposes of this analysis, and it should be treated accordingly. But even as a company claim, it represents a data point the market priced when it decided what to pay for the shares. The bullish argument in round 2 is structural rather than specific. A chip company that cannot fund the next generation of its chip cannot challenge anybody. Moore Threads has now cleared the funding access hurdle that many Chinese semiconductor startups have stumbled over. The STAR Market listing gives it access to public equity capital on a timeline that aligns with hardware development cycles, where designing the next generation of silicon typically requires spending money before the current generation ships in meaningful volume. Triple-digit revenue growth, even off a base that is small relative to Nvidia's scale, is the kind of trajectory that keeps institutional capital interested and engineering talent recruited. Nvidia's data center segment has reported revenues in the range of tens of billions of dollars per quarter in recent earnings periods, based on publicly available disclosures. Those figures should be verified against current filings, but the directional contrast is not in dispute. The entire Chinese domestic graphics processing unit market combined is a fraction of what Nvidia generates from its data center customers alone. A company growing at 155% annually from a small starting point is not closing that gap in revenue terms in any near-term scenario. The denominator problem is real, and it is large. There is a second constraint compounding the denominator. Capital without node access does not buy parity. Nvidia's current data center chips are manufactured on leading-edge process nodes, produced at foundries that export control regulations and geopolitical constraints have made effectively unavailable to Chinese chip designers for the most advanced geometries. Moore Threads, like every other Chinese chip design house, is working on process nodes that analyst assessments place at least 1 to 2 generations behind where Nvidia is building. That gap is not a cosmetic difference in the spec sheet. It translates directly into how much power the chip consumes per unit of computation and how much heat it generates doing it, which in a data center where power and cooling are ongoing operating costs means a chip on a trailing node competes at a structural disadvantage on total cost of ownership even when its purchase price is lower. Round 2 still goes to the bullish side because the momentum claim is about conditions, not outcomes. Moore Threads has assembled the conditions for a sustained challenge: public equity access, documented revenue growth, and a product in both the gaming market and early artificial intelligence inference deployments. The round comes with an annotation large enough to be legible from a distance. The denominator problem means the momentum buys iteration time, not parity. The race is happening. The distance to the finish has not narrowed yet. Now the phrase goes on trial. Rivals Nvidia is not a domestically scoped claim. Moore Threads uses it as a general competitive positioning, and it has to be scored on those terms. On those terms, the phrase fails at 3 specific joints, and the most important one is software. Nvidia did not build its moat by having the best chip in any given year. It built the moat by building CUDA, the proprietary computing platform that turned its hardware into the default substrate for scientific computing, deep learning research, and eventually the entire modern artificial intelligence training and inference stack. Asking why an enterprise artificial intelligence team uses Nvidia hardware is like asking why they use the roads their city was built around. The answer is not enthusiasm for any particular piece of infrastructure. The answer is that every tool they rely on, every framework they have invested in, every model they have trained, and every inference runtime they have deployed was designed, tested, and optimized for the existing road network. You can build a faster vehicle. If every address was planned for different lanes, the speed advantage disappears at the first intersection. Moore Threads has its own software platform, which the company calls MUSA. That is a company claim about the platform's existence, and the existence is not in doubt. The maturity gap between MUSA and the CUDA ecosystem is where the honest assessment has to be careful. CUDA has been developed over more than a decade, with contributions from thousands of researchers, framework authors, library builders, and hardware engineers. The frameworks that enterprise buyers use to run production artificial intelligence workloads have been tuned against CUDA hardware through thousands of updates. The pre-trained model checkpoints that define the state-of-the-art in most deployed categories were trained on CUDA hardware. Asking a Chinese enterprise buyer to migrate a production artificial intelligence workload from CUDA to MUSA is not a configuration change. It is a porting project, and porting projects carry risk. The risk that optimizations do not translate, that edge cases surface at scale, that the runtime behavior differs in ways that matter for reliability. Risk-averse enterprise buyers, which is most enterprise buyers, do not absorb that risk voluntarily. Reports suggest MUSA is years behind in maturity and breadth, though no independent audit of adoption or capability has been publicly confirmed for this script, and that assessment should be treated as qualitative. The node gap is physics, not policy preference. A chip built on a less advanced manufacturing process uses more transistors to do the same computation, which means more power and more heat. In a data center where electricity costs are measured in megawatts and cooling infrastructure is a capital investment, a chip that runs hotter and consumes more power per unit of useful output does not compete on the economics that procurement teams actually calculate. The sticker price of the chip is one line on a spreadsheet. The power and cooling cost over 4 years of operation is a much longer column, and a node disadvantaged chip tends to lose that column even when it wins on upfront cost. The third joint where the phrase fails is deployed scale. A chip company's competitive position in artificial intelligence infrastructure is not determined primarily by what its best chip can do on a controlled workload. It is determined by how many of its chips are running production workloads right now, because customers selecting infrastructure for new projects look at what the installed base of similar customers chose and what the support ecosystem built around those choices looks like. Nvidia's installed base of data center chips runs into the millions globally, based on directional figures from public earnings reports and industry analysis. Moore Threads' installed base, while growing, is not in the same order of magnitude by any publicly available estimate. That asymmetry is self-reinforcing. A larger installed base attracts more software optimization, which attracts more customers, which grows the installed base further. Now, the three strongest reasons this round could have been scored wrong, because the verdict here is not permanent, and the dissent deserves a hearing. The 155% revenue growth figure is a company-reported number from the quarter following a public listing. Revenue in the periods immediately after an initial public offering can reflect dynamics that are specific to that moment. Orders pulled forward by customers who wanted to be early in the queue, revenue recognition timing that bunches shipments, and buyer enthusiasm that is partly a function of the listing event itself rather than sustained demand. If the underlying revenue quality is softer than the headline rate suggests, the momentum case in round 2 softens with it, and the foundation supporting the bullish thesis loses load-bearing strength. Subsequent quarters will clarify this, but they have not yet. The node gap is treated here as a settled constraint, and it is a constraint right now. But semiconductor manufacturing capabilities inside China are not frozen. Industry analyst reports suggest that domestic advanced packaging techniques and incremental improvements in available process nodes are progressing faster than the designers of export control policy anticipated when those policies were written. If that progression continues, the specific node gap that makes the physics argument decisive in this analysis may be narrower in 2 or 3 years than it is today. The skeptics' node argument is correct as a current snapshot. Its durability as a permanent verdict is less certain. The CUDA moat has been described as unassailable for more than a decade, and the description has been accurate for more than a decade. But the history of computing is also the history of software moats that held until the hardware advantage of the alternative became large enough that customers absorbed the porting cost anyway. If Moore Threads achieves a performance per dollar advantage in the domestic Chinese market that is wide enough, and if that market is large enough to sustain the company through multiple development cycles, Chinese enterprise buyers may eventually conclude that porting to MUSA is cheaper than continuing to work around export restrictions on Nvidia hardware. The moat argument assumes the economics never shift. Economics shift. All 3 dissent points share a structure. They are time-dependent. Revenue quality clarifies over quarters. Node gaps close on a timeline that is uncertain, but not infinite. CUDA porting economics shift when the alternative gets good enough. The verdict here is a snapshot of a specific moment, December 2025, and the quarter surrounding it, not a permanent ruling. Any one of these threads could reopen the contest within a year or 2 of reporting cycles. The scorecard reads 2 rounds to 1 in favor of the bullish claim on ambition and trajectory. But the round the skeptics won is the only round that answers the question in the title. Moore Threads wins the claim that it chose the harder, more Nvidia-shaped architectural path. It wins the claim that it has the capital and the revenue trajectory to keep building. It loses the claim the phrase rivals Nvidia actually makes on three simultaneous grounds: the software ecosystem gap, the node gap, and the scale gap. Losing all three at once is not a close decision on the round that matters. The genuinely interesting story here is not the outcome of that round. It is the mechanism that produced the contest. The export controls that were designed to freeze China's graphics processing unit capabilities at a lower level did not stop Moore Threads from building. They redirected the pressure. When Nvidia hardware became unavailable to Chinese buyers who needed artificial intelligence infrastructure, the demand that would have gone to Nvidia had to go somewhere, and Moore Threads positioned itself to receive it. The restriction did not end the contest. It changed who had to build the chip. Moore Threads had to become Nvidia in architectural intention because it could no longer simply buy from Nvidia. That is what makes the company genuinely unusual among Chinese chip designers. The shape of the chip reflects the pressure that forced it into existence. What the restriction did not do is transfer Nvidia's software library, Nvidia's manufacturing node, or Nvidia's installed base. The shape of the chip is Nvidia-like. The position in the market is not. On paper, Moore Threads is the closest thing China has ever built to Nvidia. In the data center, the distance between closest thing and rival is still measured in software generations, silicon generations, and years. One of these three rounds was scored wrong, and the one most likely to be wrong is not the one the skeptics won. It is round two, and the exhibit that could change it is the revenue quality behind that 155% figure. If subsequent quarters show that the growth was structural and not driven by IPO period dynamics, the momentum case gets stronger than this scorecard reflects. Which round would you overturn, and what evidence changes it? Drop that in the comments. And if scored analysis is the reason you're here, subscribe and turn on notifications. The next fight is already being filed.